You know, there was a lot of fluctuation, but really the bottom line is the stock market's really tired right now. I mean, today was the halfway point for the S&P 500 reporting season. And as you mentioned, we've seen some big beats, like over 70% on the top line, 50-something% on the bottom line. All been good, especially financials, 80% beat with a 9% upside. That said, the market right now is focusing a lot less on the micro and looking forward to the macro, which is next week. We have the Bank of England, we have ECB, we have FOMC, we have the jobs report coming out in the U.S., we have consumer confidence and GDP, which just got revised again by J.P. Morgan. So people are shifting from micro to macro.
What about tech stocks? It seems like Facebook especially really driving some big gains on the NASDAQ.
Yeah, it's been really great. You see what happened to tech. You see what happened especially with Facebook. But Facebook in particular, I mean, they've done a very good job at figuring out how to monetize their ad space, especially outside the U.S. border. And I think that's been supportive of the stock. And there has been negative risk premium in the stock. So any kind of good news out of Facebook has catapulted it higher. It's very good to see. It's also good to see in general that the tech sector has done pretty well, especially compared to home builders and some other sectors in the U.S.
So, Larry, the big question that I've seen being asked this morning is, why are futures down? What's your take on that?
Why are futures down?
Yes.
Yeah, the future, I think because people are just tired, and we've had just a myriad of, in the last 12 hours, of just negative earnings. I mean, except for just recently. I mean, we had bad earnings come out in Europe. We had some disappointing earnings come out in the home builder stocks this morning in the U.S. Also, let's think about this. We have all of a sudden the Fed is speaking, saying, hey, it might not be Janet Yellen to take over the Fed. It might be Larry Summers. And it's not that Larry Summers' monetary policy is any different than Janet Yellen's, but it caught the market by surprise. I mean, I believe the market thought there was a 90% chance that Janet Yellen would take over, and now it's more like 50%. So I think there's more uncertainty. It's going to create more volatility. And lastly, there's been another downward revision in GDP. That's a little bit scary and just going to create a little bit more volatility going forward.
Larry, hi, it's Henry here in Sydney. I'm just looking at the Amazon figures. Were they a little bit disappointing, do you think? Is the market going to sell off a bit in tech stocks on the back of that?
You know, I do think Amazon was disappointing, but I think, you look at the PE ratio, it's astronomical. So any kind of negative surprise to the stock, it's going to go down. But people do realize that they have to focus on revenue because they're spending so much money on upgrading their technology, on buying the rights of digital content, etc. With that said, it weighs very heavily on the margin of the company. But also, when you look beyond that, growth for Amazon in the U.S. has been okay. Not great, but it's been okay. But outside the U.S., when you look at Europe, when you look especially at parts of Asia like Korea, it's been really flat to down. So I think they have a long road to hoe right now.
Is it ever going to make any money, Larry? I mean, are they ever going to turn a profit, these guys?
I can't see how they could make some money with the PE earnings the way it is, but they are expanding for the future, maybe 5-10 years from now. But to me, when I see a stock with a PE ratio that high trading at $300 a share, I'm saying there's a lot of room for that stock to go down. I could be wrong. The only reason I would buy Amazon is if I hedged it appropriately with options.
Larry, let's talk about Europe now, because they're having their reporting season as well. Not as much attention as what's been happening in the US, but you say that the signs there are more disappointing than encouraging. Why is that?
Well, it's because all of a sudden, it's funny, maybe Australians don't see it this way, but all of a sudden, the last few weeks, Americans have gotten decidedly bullish about Europe. And so the earnings season, the bar just got lifted just a little bit higher than it was even 2 or 3 weeks ago. And so when we saw this morning that some of the earnings disappointed, it just caused a negative surprise to the market. People were so bullish and caught flat-footed, so just down in the mouth about Europe just in the last 12 hours.
So you're seeing then these signs we have seen, for example, UK GDP grow, and that was ahead of expectations. You're not seeing green shoots there?
Well, you know, in the U.S., they're revising it downward. Europe, they are climbing out of their recession, but they do have a long way to go. But, yeah, J.P. Morgan came out in the U.S. and downgraded their quarterly GDP down 0.25% to 0.5%. It's not good. I mean, we're still growing, and I think that's what's keeping the stock market up, combined with the fact there's nowhere else for people to put their money. So with that in mind, not good. I think the market's very, very risky right here, given the downward pressure in growth globally, although Europe is a bright spot suddenly.
Now, we have had some Bernanke quietness for the past couple of days at least. But how's the dollar reacting, the US dollar, to what the market's doing, and where do you see it going? Some more positive signs there.
Yeah, you know, I am very bullish on the U.S. dollar, especially against the European currency, the euro. I've been dead wrong, but I think our rates are going to continue to back up a little bit. That's going to be supportive. And you combine that with some of the developing market currencies, we're going to see more outflows. That's going to create more upward pressure for the U.S. dollar. So the dollar has had a pretty wide range in July. I'm shocked to see it's you know, the euro's as high as it is against the dollar today. But I do think long-term, 6 to 9 months, that we'll see the dollar reverse and go much higher.
So, Larry, lastly, you talked about the macro concerns now that we're going to shift focus to. What do you see driving the market next week?
Well, I think what will drive it is what's going to happen with the ECB, Bank of England, but especially the FOMC. I mean, all of a sudden, there's some mystery about who's going to be appointed the successor of Bernanke. That's a problem. But also, we have GDP and consumer confidence. We need to have a GDP number that at least is what is expected. If it's a downward spiral from the low bar that's been set, then there's going to be trouble for the U.S. stock market.